Imagine a certain stock is trading in the market right now for 100. Let's say you want to lock in a price to buy that stock 1 year from today. What would be a fair forward price? Does it depend on whether the market thinks the stock will be higher or lower in a year's time? No, it actually does not depend on that at all. The forward price is fixed by the principle of no arbitrage. Today, we'll see exactly how that works. We'll start by looking at what happens if the forward price is too high, and then we'll see what happens if it's too low. This will show us that the forward price can only be one specific value. So, first of all, let's say the forward price for delivery in 1 year is 110. Here's how you could make a risk-free profit. Borrow 100 for 1 year. For our examples, we'll assume a risk-free rate of interest at 5% per annum, continuously compounded. Then use the 100 you borrowed to buy the stock in the market today. Enter a forward contract today to sell the stock in 1 year at 110. Now let's look at the cash flows. Today, you receive 100 from borrowing, and you spend 100 to buy the stock. So the net cash flow is zero. There's nothing to be paid now, and that's very important. In 1 year's time, to repay the loan, you pay back the 100 plus interest. This means 100 times e to the power of rt, with r the interest rate at 5% and t equals 1 as it is in 1 year's time. So that equals 100 times e to the power of 0.05, which is 105.13. Again, the e to the power of 0.05 is 5% continuously compounded. You deliver the stock, which you bought at the start, and you receive 110 from the forward contract that you entered into. The profit is 110 minus 105.13, which is 4.87. You've locked in today a risk-free gain of 4.87. You've not had to pay anything upfront today and are certain to get 4.87 per share in a year's time because everything has been agreed today, including the cost of borrowing and the sale of the stock in 1 year's time in the forward contract. Now let's see what happens if the forward price is too low, say 102. Here's the arbitrage strategy in this case. Short sell the stock in the market today for the current price of 100. Now we get 100 as the proceeds from the short sale, so we invest this at 5% per annum for 1 year. And we again enter a forward contract, but this time to buy the stock in 1 year at the low forward price of 102. Let's again look at the cash flows. Today, we receive 100 from the short sale and we invest this 100, so the net cash flow is again zero today. In 1 year, we received the 105.13 from the investment. We buy the stock for 102 as agreed in the forward contract, and we return the stock to close the short position. Profit is now 105.13 minus 102, so 3.13, another risk-free profit. Now that we've seen how arbitrage drives the forward price, let's derive the general formula. We've established that the forward price must equal the future value of the cost of carrying the asset. Otherwise, there's a risk-free profit to be made. In our example, we saw that the forward price had to be 105.13. Generalizing this, for an asset with spot price S0, risk-free interest rate R, and time to expiration T, the forward price F0 is equal to S0 times e to the power of RT. And the subscript represents time. So here time is 0, so today or now. So the F0 represents the forward value of the spot price compounded at the risk-free rate, which in this case represents the cost of carry, which is the cost of owning or carrying the asset. In this simple case, the cost of carry was just the risk-free interest rate, but the cost of carry can include other factors, such as other costs like storage, but also benefits such as dividends or other types of income. To generalize this, we can write the forward price formula as this, where now instead of R we have C to represent the net cost of carry. This C can be thought of as the sum of all the costs and benefits of holding the asset. Let's look at some examples to see how different factors affect the cost of carry. In most of these, the risk-free interest rate is a cost. We add on any other costs and subtract any benefits. Stocks, equities, the risk-free interest rate minus the dividend yield. Bonds, the risk-free interest rate minus the coupon yield. Currencies, the domestic risk-free interest rate minus the foreign risk-free interest rate. And commodities, like gold and oil, the risk-free interest rate plus storage, insurance, transportation costs, minus the convenience yield. This convenience yield is the benefit of holding the physical asset, such as ensuring immediate availability or avoiding potential shortages. We can include it in our cost of carry calculations. However, in reality, the convenience yield is often unobservable and unpredictable, which means it is very hard to calculate the theoretical no arbitrage price. Therefore, while we can use the formula, we need to be aware of the limitations when dealing with so-called consumption assets, which includes most commodities. So far, we've primarily considered continuous costs and benefits in our cost of carry calculations. What happens when we have discrete income, like a stock paying a fixed dividend amount? For that, I'll need to explain a bit more about how to calculate present and future value, so I'll leave this for the next lesson, in which we will look at the fundamental concept of time value of money. In this lesson, we derive the formula for the forward price of an asset through a no arbitrage argument, focusing on the cash flows of buying the asset and borrowing funds. Remember, the key is to ensure that there's no risk-free profit to be made. Please leave any questions in the comments below. Don't forget to subscribe for more insights into derivatives and risk management.